At the end of the day, the consumer's been relatively strong. They've held in there. They continue to grow their spending. So demand's there, but businesses have gotten more and more cautious, really facing in this question. If you're told that there's going to be a decline in the economy, soft landing we predict, but still from a 4 to 5% growth rate to 1% growth rate is a steep slowdown.
Investors have underestimated and underpriced the significance of the macro uncertainty that exists now since few people have ever faced it. The 2023 recession that many had predicted never materialized. Today, we are going to discuss the Bank of America's terrifying forecast, which got investors on edge. In many regions, inflation peaked in the autumn of 2022, and disinflation persisted into 2023, despite overall economies performing better than anticipated. The economists and strategists at BofA Global Research have revealed their predictions for 2024, and they predict that the disinflation will persist and that the Federal Reserve and the European Central Bank will start reducing interest rates in the middle of the year. The rate increases over the past 18 months should eventually slow down the economy and raise unemployment rates, but our experts are predicting a gentle landing rather than a recession. 2023 unfolded in a manner contrary to widespread expectations, with anticipated recessions failing to materialize, projected rate cuts remaining unrealized, bond markets showing a limited upward movement except for brief, intense spurts, and the ascent of equities causing discomfort for cautiously underweight investors, remarked Candace Browning, the head of BofA Global Research. Browning added, "Our outlook for 2024 envisions a scenario where central banks can effectively engineer a soft landing, acknowledging, however, that the landscape is not without its share of downside risks, potentially outweighing the upside possibilities." Claudio Irigoyen, who leads global economics, anticipates a gradual decline in inflation worldwide, paving the way for several central banks to implement rate cuts in the latter half of 2024, thereby averting a global recession. Head of U.S. economics, Michael Gapin, predicts the initial Fed rate reduction to occur in June, with subsequent quarterly cuts of 25 basis points throughout 2024. Chief investment strategist Michael Hartnett envisions the primary drivers of the bullish markets in 2024 to be the three Bs: bonds, bullion, and breadth. He expresses a heightened concern for the possibility of a more severe economic downturn than expected, awaiting the classic combination of bearish investor positioning, declining corporate profits, and accommodative policy, the three Ps, before transitioning to a fully bullish stance. Savita Subramanian, the head of U.S. equity and quantitative strategy, maintains a positive outlook on equities, not solely due to the anticipation of the Fed initiating rate cuts in the coming year, but more so because of the consequential effects of the Fed's prior actions and the adaptability demonstrated by corporations. Despite a slowing GDP, earnings per share have proven capable of accelerating, and companies have identified reshoring as a favorable factor. OPEC Plus has been implementing supply cuts since 2022 and is likely to continue this trend into 2024. Francisco Blanch, the head of commodities and derivatives research, foresees a growth in oil demand by 1.1 million barrels per day in 2024, particularly as emerging markets benefit from the conclusion of the Fed's monetary tightening cycle. Nevertheless, Brent and WTI prices are expected to average $90 a barrel and $86 a barrel respectively. Potential downside risks to oil prices include a recession, faster than expected growth in U.S. shale production, and a lack of cohesion within OPEC Plus. Lower interest rates are anticipated to positively impact gold prices and stimulate restocking in industrial metals. Returns in emerging markets tend to be notably positive in the 12 months following the final interest rate hike in a cycle by the Federal Reserve, and current positioning indicates limited exposure across EM assets. The growth of China's economy is expected to stabilize. The BofA Global Research Division comprehensively covers over 3,500 stocks and 1,250 credits on a global scale, consistently securing top-tier rankings in various external evaluations. In the latest recognitions, it achieved the number 2 position for the title of the Global Research Firm of 2022, according to Institutional Investor magazine. Furthermore, it secured the top spot in the 2023 Institutional Investor All-American Survey, the 2023 Institutional Investor Developed Europe Survey, and the 2023 Emerging Europe, Middle East, and Africa Survey. Additionally, it attained the number 2 position in the 2022 Institutional Investor Global Fixed Income Research Survey. One of the top financial organizations in the world, Bank of America, offers a comprehensive range of banking, investing, asset management, and other financial and risk management products and services to individual customers, small and middle-sized enterprises, and major corporations. With about 3,900 retail financial centers, about 15,000 automated teller machines, and award-winning digital banking with about 57 million verified digital users, the company serves roughly 69 million consumers and small business clients in the United States with unrivaled convenience. Bank of America holds a prominent position as a worldwide leader in wealth management, corporate and investment banking, and trading spanning diverse asset classes. Catering to corporations, governments, institutions, and individuals globally, the bank provides industry-leading assistance to around 4 million small business households through a range of innovative, user-friendly online products and services. With operations extending across the United States, its territories, and over 35 countries, Bank of America is committed to serving a diverse clientele. Projections for the bond market in the upcoming year, initially regarded as pessimistic when released in November, became impractical due to the decline in yields following the Federal Reserve's shift towards anticipated interest rate cuts next year. The altered landscape led to a reconsideration of previously optimistic forecasts, creating a divergence of opinions among major banks. TD Securities remains notably optimistic about bonds, while Bank of America Corp and Barclays PLC are among those expressing more skepticism. The collective forecast from strategists at major financial institutions indicates a median expectation for the 10-year U.S. Treasury yield, a benchmark influencing various markets, to decrease to 3.98%. Although this is not significantly different from its level of 3.93% as of the latest market close, it represents a notable decline from its pre-Fed pivot yield of 4.2%, itself a reduction from the peak above 5% in 2023. TD Securities, at the more conservative end, envisions a 10-year rate potentially dropping to 3% a year from now, influenced by a projection of 200 basis points in Federal Reserve rate cuts, commencing in May. Goldman Sachs Group Inc. and Barclays, adjusting their stance on the likelihood of rate cuts before the fourth quarter of the next year, predict yields to conclude 2024 at 4% and 4.35% respectively. Chris Ego, Chief Investment Officer of Core Investments at AXA Investment Managers, expressed in a report on December 8th, prior to the post-Fed surge in treasuries, that the expectations for 2023 to be the year of the bond have not been entirely realized. He noted that the performance of government bond markets has been below expectations. Only a small number of people properly predicted what transpired, including Goldman Sachs, whose team, headed by Praveen Korpati, now predicts that the surge will fizzle out in 2024. Some are just starting the year with the mantra, buy bonds. On December 11th, analysts at Jefferies International Limited informed investors that bonds will outperform equities as central banks started cutting interest rates, stating that we expect 2024 to be the year of fixed income. Nevertheless, the authors stated, it is likely that 2024 will be another challenging year for macro forecasts, with due respect to analysts across the spectrum. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comments section below.